This tutorial is going to discuss adjusted cost base, how it's calculated, and why it's relevant for capital gain reporting. So if you take a security that you're buying and selling and have income activity on it and perhaps have some uh, tax cost adjustments on it, um, it's important to track the cost base, the adjusted cost base. And as an example here, we'll take a look at TD. So this report will reflect all the activity in the account, in this particular account for this stock, and all the buys and sells. So this report, which is the continuity, and I just showed you the filtering of it. You do a number of things. You're buying it, you're selling it. There could be ACB adjustments for different reasons. There could be just a triggered capital gain. It doesn't happen in the stock, but things happen just as an example. There could be ACB adjustments that are cash-based or returns of capital. So what that does is it affects the cost base of the security. And so initially, if you buy 1,000 shares at $25, your cost base is $25,000. And if you buy a little more at a different price, your cost base becomes the sum of those two plus the sum of their two costs, and so on until you sell a piece of it. So here you would have sold 500 shares out of the 3,000 you had accumulated. So you have to then report a capital gain. And what the system does is, okay, here's your capital gain. That's the money you brought in, the proceeds. And here's the tax cost of those particular shares, which is really a prorated value of the total monies you paid. So you paid a total of $225,000. You've sold 500 out of 3,000 shares, so therefore pro rata, this is your tax cost of those shares you sold. The result being your net gain or loss, and then your final balance position. That's your adjusted cost base, excuse me, and why it's relevant for your capital gains reporting, because all your capital gains and losses are dependent upon how you calculate that cost base. Now, if this was a U.S. security, when you buy and you sell in a U.S. denomination, you should report that or convert that into Canadian dollars at the exchange rate at the time of the trade. If this was a U.S. security here, the program does that for you automatically. It gets the currency prices, as we talked about before in another lecture, from the currency price feed. So you don't have to deal with that component of it. And I believe that it goes back 3 years. So the other adjustments you can have for cost base are cases where there may have been some event at the company, some non-cash tax event, and you have to increase the cost base. So you, from the trade screen, you can select, you'll recall an item called ACB adjust non-cash. You can plug in $100 or whatever it is. It'll add to your cost base, but it won't affect your cash balances. So it's some useful for income trusts, things like that, or limited partnerships where you may get deemed some kind of income, but you don't actually receive the cash. And conversely, you have ACB adjustments where there is cash, so you can book that amount, but it'll actually put it into your account. Cash will have come, or in this case, will go out of your account. So that'll add to your cost base as well. Then there's return of capital where, like a mutual fund trust, they'll mail you some money or some REITs. You'll get some money in your from the distribution, but a portion of it will represent a return of capital. And so you can reduce your cost base by typing in a negative 101 return to capital and reduce your cost base so that that money you received is not currently taxable, but when you ultimately sell the security, it will be reflected as an additional capital gain. So on cost base, this can be the most tedious thing to deal with in securities and buying and selling and REITs and all that kind of stuff. So if you get your data in the program and label the trades correctly, that all will be done for you. And that's the biggest benefit of the program. And it's critical because you don't want to over or under declare your true capital gain and the tax consequences associated with that.